Okay, so let's get started. We have a lot to cover today. Cases, Pinnacle. Can you pass them up? We're going to go over them in class today. Okay. All right, so if you have anybody who has it, just pass it up. So today what we're going to cover, we're going to work on the flash technology case. So you should have gotten my email indicating that you didn't have to answer the questions, but you should familiarize yourself with the case. We're going to spend a few moments in class discussing it in informal groups and then go through the case together. We're going to also, can I have your attention, please? Okay. All right, and we're going to, as I said, we're going to go through the Pinnacle case as well today. Okay? So how many people are Knicks fans? Not that many. Why? You couldn't possibly be New Jersey Nets fans. Come on, we have a better team than New Jersey. I said, who in here? I said, who are New York Knicks fans? And I saw like 2 hands. Come on, insanity! It's exciting at the Garden again. Oh my goodness, you can't get tickets? That's a first. Okay, well. Anyway, so we're not going to talk about insanity. It has nothing to do with the audit process or planning. So what Flash technology, the case Flash technology is about, is an introduction to the types of things that an auditor has to do or should be doing in the audit planning process as they gather information about their client. So in this case, Flash Technologies is a new client, a new audit client. Okay, I have a loud voice, but I really can't compete over additional voices. So is everybody settled down and we'll get started then? Okay, all right. So in this case, Flash Technologies is a brand new audit client. And so remember, we talked a bit about the continuance process as well as new audit clients. And what's important in both those situations is that an auditor is going to assess the client's business risk. Later either next week or at some point at least begin this discussion of how we integrate that risk assessment into the audit process in terms of helping the auditor to identify the audit approach and audit procedures. So what we're trying to do in the audit planning phase is obtain enough competent evidence, sufficient competent evidence to be able to give an opinion on the financial statements. It also, you can't obviously go in and just blindly start auditing. You have to have a plan, an approach. We talked about last week management assertions and the importance of that, and as we go forward, we'll build those management assertions into the audit evidence gathering process. And obviously, you want to avoid any misunderstanding with your client about what you're actually responsible for doing and what they can expect from you as an auditor. So remember, again, the financial statements are the responsibility of management, and management has to understand that. Also, it's important for management to understand that the internal control environment is their responsibility, and the auditor is not there to develop an internal control environment for them or procedures for them, nor is the auditor there to prepare financial statements. So most clients understand this, but it's important for the auditor to make sure that this is said and identified in the audit planning process. In terms of the planning approach, there's 8 overall steps that is involved in the audit. But I would say the first 6 steps really are related to planning. So in terms of accepting the client and performing the initial audit planning, again, what the auditor is doing is assessing the risk, getting to understand the client's business, the client's industry, and you saw, as you read through the Flash Technologies case, it gave you a lot of information about, background information about that client so that you'd be able to determine what the business risk was, what kind of risk exists in the industry, what types of financial reporting risk exists. So That's what the auditor is doing, is gathering information to be able to determine those types of risks. Also, understanding the client's business and industry. This is really important because when we talk about the audit risk model, there's a component of the audit risk model that relates to inherent risk. And I'll talk about that more, but inherent risk really is something that an auditor can assess. It's not that they can point to any one thing and says, oh, inherent risk is high. Right? It's a combination of factors and that the auditor assesses or evaluates in order to come up with inherent risk. So understanding the client's business and industry is an important part of that. And as a result of that, they also have to understand the client's business risk. Where is the risk for this client? Okay. What kind of risk do they face? Are they a client that's in a highly competitive industry? You saw that in Flash Technologies. And so if they're in a highly competitive industry, what impact does that have on them? And how could that competitiveness in the industry impact financial reporting? Perform preliminary analytical procedures. What we'll talk about going forward is the importance of analytical procedures, and you saw that with your Pinnacle case. So the Pinnacle case, the first part of it really dealt with doing trend analyses, ratios. So that's what analytical procedures are. They will look at the planning stage, where is there potential for misstatement? Are there any accounts that seem not to mesh with what my understanding of the business industry tells me, or what my understanding of the client's business tells me? Is there something that doesn't seem to make sense? And it could be a potential misstatement. And so where Flash Technology focused more on the risk assessment process with respect to planning, the Pinnacle case focused more on the analytical procedures that auditors engage in. We'll probably begin this discussion today, but complete it next week, talking about materiality and the audit risk model. And that's where in the audit risk model, auditors assess inherent risk, and they also assess control risk. Okay? So we'll talk about those things next week, and then they gather information to assess fraud risk as well, and we'll talk about that in a few weeks. But that's what SAS 99 talks about, the auditor's responsibility as it pertains to fraud. So again, just to reiterate, SAS 99 doesn't say that auditors audit to detect fraud. That's not what it says. The audit is not a fraud audit. It's an audit of financial statements. Okay? But what SAS 99 says is that the auditor has to assess fraud risk. They have to look at the accounts and look at the client's business and determine where there's a potential for fraud. So in assessing control risk, if the company has weak, ineffective controls, you would believe then, or it would suggest that the risk of fraud may be higher than in a well-controlled environment, right? And so if that's the case, the auditor is going to adjust their audit approach so that they can increase the likelihood of detecting fraud if it does exist. Okay? So we'll bring all of that together, and then after the auditor does all of these, go through these steps, assess fraud risk, assess control risk, assess inherent risk, understand the client's industry. Using that information, they develop an overall audit plan and program. So part, as I said, step one is in the initial audit planning is the client acceptance and continuance, and the auditor's responsibility is to identify the client's reasons for the audit, obtain an understanding with the client, and develop an overall strategy. With client continuance, it's an existing client. So you've worked on that client before. It's been, whether you've had that client for a number of years or a couple of years, you now have information about that client. So you are going to base your audit procedures or your approach on the information that you've gathered in previous years. But you still go through this annual evaluation to determine if there's anything new. Are there any issues that didn't exist in the previous years. Is the company issuing stock? Is the company borrowing more money? That changes your risk in a way, okay? Do they have a new CFO? Are they involved in litigation? So you want to assess this, because it's not enough to just say, I audited this client last year, I'm just going to use last year's audit approach. You can't do that. The standards don't allow for that, right? You use it as a guide, but you have to go through this assessment process even for continuing clients. Client acceptance is when you have a new client, and in this case, the auditor is going to basically do the same thing. The difference is they'll probably have a more extensive investigation, because they have to determine whether or not this is a client that they want to do business with. Right? So they'll do client investigations. They'll talk to business associates of the clients. They'll talk to, for example, the attorneys that the client uses, bankers that the client banks with, so that they're trying to determine what type of client this is, management integrity, and things of that nature, as well as communicate with the predecessor auditor. That's required by the standards. Basically, it's an important part of the audit process, because what you're concerned about here is there's a risk. Engagement risk is a risk to the auditor. Right? So the auditor faces litigation. Whether they've done a great job, if someone perceives that there was a fraud, and we already know that the audits, we don't look at 100% of the items, so the auditor is only providing reasonable assurance. So it's possible that they can do an audit in accordance with all of the audit procedures and generally accepted auditing standards, and there's still a material misstatement, or there's still a fraud. It doesn't mean that the auditor was necessarily negligent, but a third party might see it otherwise. So the auditor wants to make sure that they do a really good job, an effective job of evaluating their clients to reduce their engagement risk as well as their audit risk. Okay. Identify the reasons for the audit. Two ways that the auditor does that. What's the intended use of the statements? Or the client, if this is a company that's borrowing money and they're audited, the lender requires audited financial statements, then that's going to be fewer users who are relying on those statements. If it's a publicly held company, obviously there are going to be an infinite number of people who might use those statements in a business decision. So it's important to understand what the objective of, who are the users of the financial statements, what the financial statements are going to be used for. Obviously, publicly held companies, auditors have a greater risk, right? And so, and when we talk about the audit risk model, we'll talk about this in a more detail. So the auditor wants to keep that audit risk low, right? They don't, because what the audit risk says is that's the risk that the auditor is willing to accept, that they issue a clean opinion, right? And it turns out that there's a material misstatement in the financial statement. So they want that risk to be low. And so in order to keep that risk low, they really have to make sure that they collect a sufficient amount of evidence, appropriate evidence. Okay, and so your audit risk is really going to drive, in conjunction with control risk and inherent risk, the amount of evidence the auditor collects. So for a publicly held company, they inevitably have greater risk because of the numerous amount of people who use those financial statements to make decisions. And also, I'm sorry, and then for companies, obviously, who are highly leveraged, clearly, when a company is highly leveraged, the lenders are going to have things such as bank debt covenants. They're going to, for example, they might have built into the loan agreement that the company has to maintain a certain current ratio, or the company can't, their debt to equity ratio can't be above a certain number. Okay, so they put restrictions on the company. And then if a company is likely to be sold, clearly the company or individuals who are buying the company are going to want, you know, very good financial statements or pretty good assurances. In terms of obtaining an understanding with the client, the engagement terms should be understood between the auditor and the client, and you see that in what we call an engagement letter. So the engagement letter should describe the objectives of the audit, the responsibilities of the auditor versus management, when the audit is going to be completed, by what time, what information management is going to provide, the fees that the auditor is going to charge, and basically it's important for the auditor to let the management know that they're not guaranteeing that they will uncover fraud, because they're not conducting a fraud audit. Okay? So it's important to highlight that in the engagement. In terms of developing the overall strategy, and the auditor is going to assess the client, consider the client's business and industry, consider where there's a material risk of misstatement, the number of client locations, the internal control, and what you'll find is the client's business and industry, those types of accounts where there's a risk of material misstatement, a number of client locations, those are things that are factors that impact inherent risk. The effectiveness of the internal controls obviously is control risk. The combination of inherent risk and control risk is what we determine to be the risk of material misstatement, that combination. And both those factors, inherent risk and control risk, the auditor can only assess, right? They can only assess that. That's all based on client information or external information. The auditor also has to determine whether or not, what kind of staffing they need and whether or not they need specialists. So how complex are the transactions? So for example, if the company, for example, is a financial services company, or even if the company has a lot of assets or a significant amount of assets that are valued at fair market value and driven by fair market value accounting, sometimes you might have to bring in an expert, especially if it's a level 3 asset. So level 3 asset is where there is not a ready market for that asset. So it's harder to determine what the fair market value of that asset would be because there's not a ready market for that asset. So a lot of times the value of those assets are based on modeling, right? So clearly the auditor is not, that would not be a basic auditor who, you know, undergraduate degree in accounting, certified public accounting. They're probably not going to have that expertise, and that's where they would need to determine whether or not they need to bring in specialists. So those are all important factors the auditors have to consider in the process of developing their audit strategy. So we're going to kind of segue into this right now with respect to Flash Technologies, is understanding the client's business and industry, looking at industry and external environments, what the business operations and processes are, what's the management governance like, what's the integrity of management, okay? Is there an effective audit committee in the sense that the audit committee doesn't only just meet the standards or rules prescribed by regulators, but that they actually do their job, right? That they're actually involved in the oversight of financial reporting, and they understand that and carry out those responsibilities. What's the objectives and strategies that are in place for management, and how is it measured? So let's turn now to Flash Technology. So what I want you to do is, Flash Technologies, you're going to assess what the risk is for that client, right? And some of the things you're going to look at is the client business risk, right? And the business risk in the terms of general risk that's specific to that particular client, Flash Technologies in this case, and the industry risk for that industry that Flash Technologies in, as well as how that then translates into financial reporting and accounting risk. So you should have read the case. So take about 15 minutes and discuss those things in your informal groups. You don't have to break into your formal groups, but just kind of in where you're sitting, get together. So you're going to address general risk. Okay, so remember, so from Flash Technologies, you know this is obviously a technology company. It's in a rapid growing high-tech industry. They're in the process of changing auditors, so they're a publicly held company. They've had auditors in the past. They're changing their auditors because they're expanding into an international market, so they want auditors with a more international presence. Okay, let's walk through this together. So before we move into talking about the risks specific to flash technologies, I want to just point out the standards that cover this process and what that guide the auditor in terms of risk assessment and responses to risk. So keep in mind that we do have AICPA standards as well as PCAOB standards, and so publicly held companies are governed by the PCAOB standards. And remember, in the beginning of the semester, I talked about how slowly but surely the PCAOB is replacing some of the standards by the Accounting Standards Board under the AICPA because they've identified areas that they want to enhance the procedures or requirements that auditors or guidance that auditors have to follow. And the risk assessment standards are an example of that. And so under ASB standards, that's put out by the under the governing rule of the AICPA, you have 4 standards that if an auditor is auditing flash technology, they would be bound by these standards with respect to the risk assessment process or the planning process. Overall objectives of the independent auditor and the conduct of an audit in accordance with GAAP. You can find that under AU 200. Consideration of fraud and financial statement audit, AU 240. Performing audit procedures in response to assess risk and evaluating the audit evidence, AU 330. And then finally, subsequent events and subsequently discovered facts, AU 560. The PCAOB has gone in and increased the risk assessment or the standards dealing with risk assessment and the response to risk assessment. And I believe that I have posted, I think it's a CPA Journal article that summarizes these risk assessment standards that were issued by the PCAOB, I think maybe about 2 years ago, 2 or 3 years ago. So if I haven't posted it, I'll double check and I'll post it because it provides a good summary of these standards, and it's important for you to understand these standards and know them. The PCAOB standard has audit risk, where they talk about the auditor's responsibility and the guidance, provide guidance for audit risk. That's AS8. Identifying and assessing the risk of material misstatement, which is AS12. The auditor's responses to the risk of material misstatement. So not only are they responsible for identifying and assessing risk, the standard also provides guidance on how they should respond to that risk of material misstatement. That's AS13. And then finally, evaluating audit results, which is AS14. So those are very important standards, and you want to make sure that you understand the general. I'm not asking you to memorize the standards, but just understand the overall objective of those standards. And as I said, if I haven't done so already, I will post an article that summarizes the PCAOB standards really nicely and succinctly. Okay, yes. Now it's green. Okay. 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 So let's talk about some general risks that you identify. General business risks related to flash technologies. What are some of the things you noticed? Competition, right? Why is that a risk? Right. Right. And what's unique about the competition for flash technologies? What's unique about that? Right. Their product is using a lot of technology, and it's the fact that it's the technology industry, right? So what's unique about the technology industry? It's always changing, so you have to be rapid. And what about their competitors? You said competition, so let's focus on competition's key. What about their what is it about their competitors? Natasha? Very intensive competitors. What's the makeup of their competitors? What are some of the competitors noted in the case? Scandis, Smart, Mitsubishi, what else? I know who you're talking about. I can't say it either. Right? It's not rolling off the tongue. And what about what's different about those competitors as compared to Flash Technologies? Yep. Right. Exactly. So they have the ability to manufacture at a lower cost because of the way that they're structured, and they're larger. There's some that are much larger. And what comes with size? In addition to being able to market share, exactly. So now you have, Flash Technologies has to go up against some well-established companies who are better marketed, have better organizations. They can produce for less. Yes. Right. So they produce a lot more. So they can probably get product to the market faster. They are not going to be as concerned about not being able to meet market demand, whereas Flash Technology is pretty new, right? It's much smaller. Okay, so what other kinds of risks? What else did you know? Yes. Right. They have a higher reliance on one customer, so that's a huge risk. They have limited suppliers, so they could, if one supplier can't provide them with the raw material that they need, it's going to really impact their production capabilities. Right. What else? What are some other risks? Natasha. Right. So say the first part again. Well, okay. So they're making a huge investment, but so there's the chance of right, that they can catch up. Right. Yes. Right. Lower margins. What's some other risk? I'm sorry. I'm sorry. Supply sources, yeah. I think someone pointed out that they have very few suppliers. Right. They're expected to reduce even more. A high cost of R&D. Yep. What are some other things? What about industry? We talked about competition. Anything else with the industry? Right, so rapid changing because of technology. What else? Right, the industry is growing rapidly, so there's concern that they'd even be able to keep up with the rapid growth of the industry. What about things? Okay, so we talked a lot about what about business risk related to management or personnel, people? Right, exactly. Because they're expanding into an international market, right? And so do they even understand the rules of doing business in that market? Doesn't say anything about whether or not they, are partnering with, people who can help them integrate into that market. What else related to acquisitions? Entering new markets. Right, they entered into a joint venture, right? They own 51%, so there's concern there. That poses some risk, but maybe legal. What else? What other kinds of risks? What's another risk of going into a foreign market? Currency risk, right? That goes over into to reporting, but yeah, accounting risk is currency issues. Regulation, right? You don't know what the regulatory requirements are. Yes. Cultural, exactly. Cultural differences in how you do business, right? We were just talking about this in a meeting yesterday about the Foreign Corrupt Practices Act. Right? You have some countries where bribing officials are just the way you do business. But you can't do that if you're an American-based company. So how do you navigate around those kinds of things? Because you are subject to severe fines, right, by the American regulators if you do that. But what do you do with you have to have something in place. You have to have controls in place. You have to have procedures in place so that the people that you're dealing with understand that that's not how you do business, right? So that's a concern. This is, again, cultural. This is, from a business perspective, how some countries do business. It's just the way they do business. They're not bound by American regulations, but you as an American company have to be bound by American regulations. So those are issues too. You have to know what the business landscape is. Any others? What about financial reporting risk? What are some of your concerns? Inventory obsolescence, why? Exactly. Right. So that's always going to be a huge concern, right, with technology companies is the obsolescence. And managing their inventory production, I think Natasha pointed out that they're investing all of this money, but how well have you looked at the investment in terms of the return? Like, are you investing in all of this different equipment? Can you only use it for one? Is it only good to produce one product or multiple products? So you have to be aware of those types of investment decisions, capital investment decisions. What other kinds of financial reporting? Right, so you have financial reporting rules. So U.S. is GAAP, but as a U.S. company, you have to understand that you still have to, at this point, we haven't converted to IFRS, so you're still bound by U.S. GAAP, right? But if you still have to report in other countries, and so it's important to have the expertise or people on board who understand the reporting rules in other countries. You might have to pay taxes if you're doing business in other countries, and a part of that is having financial statements. So you have to understand what those rules are.
Corruption, assistant corruption, maybe check if the facility payments are regularly.
Right, you got to have procedures in place to identify whether or not. So from an audit perspective, you might, depending on the country they're in, if there's reason to believe that the way that that bribery is an issue in those countries in terms of how they do business, you as an auditor are going to focus on payments, right? To make sure, to try to determine whether or not there are any payments that should not be made, that are not for legal purposes. What else? What other kind of financial reporting issues? Just inventory? What's another issue? I think somebody told me there was one customer. So that's normal? That wouldn't give you any pause? So, if you, Right, so it's not a good business, it's a business risk. But how does that business risk translate to financial reporting and accounting risk?
Well, I guess there's not independence, maybe they can possibly help each other and maybe at the year final quarters, say we'll buy a business consignment or...
Right, so you'd be concerned about revenue recognition issues or overstatement of revenue, right? Is there a close relationship? It didn't, I believe in the case it talks about that, doesn't it? Who has a, yeah.
I don't know if it's the CEO, he's the board of directors for the...
And it's a customer, right? A customer's on your board of directors that, all right, right. That gives you concern as an audit. Yes, Natasha. Right. Right. So they have one customer. They have this huge increase in sales. Why? I mean, even if you had more than one customer, you'd want to know if you saw such a significant increase in sales, what's driving that? If it doesn't seem that it's consistent with other business information you find out. Yes. Right. That seems extreme. That's a really huge profit margin, right, on a product. That it costs you $20 to make the product and you can sell it for $300.
Yeah, I mean, it's big.
Right.
There's so much competition. Why would it have such a high profit margin?
Exactly. Right. And so you as an auditor would definitely want to do some inventory, really look very closely at the inventory costing methods that they're using, right? To see if they realize, and I think some groups pointed out R&D, you know, are they, you know, trying to show a greater profit so they're not recognizing all of the costs that they should be recognizing related to that particular product, that they're, you know, maybe they're not allocating enough overhead. Maybe there are problems with their, you know, with their overhead allocation, as well as maybe they're not allocating all the labor that they should be to that product because they're trying to sell, you know, show a greater profit margin on it. So you'd be concerned about the inventory costing methods that they're using. What? That the SEC is investigating them. That's a red flag. Right? That's a concern. The SEC, I mean, if, you know, is not just going to investigate you for no reason at all, especially with the limited resources that they have. Okay. What other balance sheet, income statement accounts would you be concerned about? Yes. Right. Why? Right. So because they have such limited customers, these two customers hold like 25 or 35% of their sales and their receivables. So if they don't pay or they're facing you know, financial problems, that's going to definitely have an impact on the Flash Technology's ability to collect on those receivables. So the allowance for doubtful accounts would be a concern, a risk area. Yes, Oscar. Yeah, so they had they had a purchase of a company, so you'd want to look at, you know, that they properly accounted for the purchase of that company. Is there goodwill? How are they accounting for that, right? So you want to look at that. So that's a risk, an area of potential misstatement for them. What about any concerns about management at all? Did anyone have any concerns about management? Right. So what was some of when the auditor did their initial background check on the CEO, Manny, they found, you know, people had some really bad things to say about him. What did the auditor do when they found that out? What steps did the auditor take? Right. And what did she say? Was that sufficient for you guys? What would you have done? What would you have done? Do additional background? Yeah. Mm-hmm. Right. So in other words, it should have been a red flag for the auditors. So it's not enough to just accept the CFO's explanation that, it's just jealousy or whatever. It's a red flag. Because it's a huge concern to you as an auditor if management lacks integrity. That increases your inherent risk. All right, so let's take a look at a few of the, I think we've covered a number of them. So they're pointed out publicly, it's a public company, which makes it risky from an audit perspective. It increases risk, I should say. Public high-tech company, so they're going to, because it's public, there's going to be extensive reliance on the financial statements, right? Because you have multiple people, and you don't know who's relying on it, but it's a publicly held company, so there could be 10 people, it could be 100 people, it could be 1,000 people who own the stock. It's in a rapidly changing industry with respect to technology. So some of the industry risks, the rapid technological changes, evolving industry standards, rapid product obsolescence, intense competition. So all of those everyone raised. They entered into this Korean joint venture, and as well as other acquisitions, the DCI acquisitions. And the concern here is, does the current management team possess the necessary global management skills, right? Because they're going into a foreign market. DCI has a history of losing money, so there are many uncertainties about that. Flash memory represents 98% of sales. That's huge. So there's a lot riding on that particular product. So there's extreme reliance on that one product. What happens if better technologies develop, especially considering their competition, that they have competition who are competitors who are much more poised to enter the market rapidly, to outproduce them, to outspend them in terms of marketing, to be able to, those competitors are able to produce at a lower cost, right? Supplier relations, financial statements indicate there's a critical issue as the company has only one supplier for many of their critical components, and they have no long-term contracts with these suppliers. So even if a supplier doesn't have financial difficulties, if one of their competitors comes along and offers that supplier a much better contract, or offers them a long-term contract at a more profitable rate for the supplier, what do you think the supplier is going to do? They have no allegiance to Flash Technologies. Two major customers represent 25% of sales. Another risk is there's been extreme growth, which I think Natasha pointed out, operating and financial management expertise. So the company is growing, or it seems, but you don't see a change in the structure of management. You don't see them bringing in new people, right, with better experts. Because it's pretty different to manage a small company than it is to manage a conglomerate, right? You need more people to manage that conglomerate. So you don't see that there's no indication that they're adjusting their senior management level to address the growth. Short sales of stock increasing. What is short sales? Yes. Right, more people are shorting stock. So what does that mean? Why would that be a risk? What does that signal? Right, they don't believe that the stock is worth, they don't believe the stock price is going to go up, right? So if the market doesn't believe the stock is going to go up, that's the market's perception, right? So where's your capital going to come from? If you try to raise capital, you're going to have to borrow possibly if you can't raise enough capital through the capital market based on the value of your stock. What might that create for management with respect to perhaps fraudulent financial reporting? What kind of short selling? What might that create? What kind of behavior might that create in management?
Force them to be in a situation where they have to, like, overstate
Right. So, right. Right, they might try to dress up their financial statements to convince the market that they're doing better than they really are doing. So that might, so if you're the auditor on Flash Technology, that's an inherent risk. That you'd say, okay, they're selling there's a lot of short selling. The impact, not saying that management is going to do it, but the impact could be that now if management is really concerned about market perception of the value of their business, does that create an incentive for them to try to report better results than they actually achieved? So that's an example of inherent risk. FlashWall 2011 sales to one company, and that company is or will be a related party. Patent litigation, SEC investigation, and then we talked about the allegations that Manny lacks integrity and has been on the history of wrongdoing. And has a history of wrongdoing. Some other general areas of risk, some of these are, we've mentioned already, DCI experience and loss it. There's a pressure to increase sales to be a leader in the flash memory market, so that creates an incentive. And when we talk about the fraud triangle, and if you haven't, it's, opportunity, incentive, and rationalization, right? And so they have incentive because they want to be a leader. They're trying to be with the big boys. They're trying to get bigger. There's some conflict on the Korean Peninsula, which could possibly halt manufacturing procedures. Okay, so now all of a sudden they run the risk of not being able to meet the demand. Suppliers are unable to meet demands needed for inventory production. We talked about foreign currency fluctuation, new market entrants, with better technology and cheaper prices. We saw someone pointed out that they could, the competitors could produce at a much lower price. We already talked about the SEC investigation, talked about new technology that could undermine flash memory. They're banking a lot on AT&T, this alliance with AT&T, and they in fact are releasing this information to the market, but no contract has been signed. So, if that doesn't go through, then, the revenue that they thought they would realize is not going to materialize. Many major customers failing to pay off receivables on a timely basis. Delays in the operations for the Korean subsidiary or joint venture as a result they can't meet demands. We talked about already the two major customers and the short selling of stock as well as patent litigation. So financial reporting and accounting risk. If you looked at the financial statements, accounts receivable is up significantly, and the allowance does not appear to be keeping pace. Right? So that's a concern that the allowance for doubtful accounts is understated. What is the increase in other current assets due to? If you notice on the financial statements, current assets increase. Why would current assets increase? Okay. Inventory is up significantly. The turnover ratio is only 1.8, suggesting potential problems with obsolescence or existence. Rapid increase in sales. Is this reasonable? Does it raise revenue recognition issues? It would seem that research and development expense would be greater given the growth, but yet you see a lower number for R&D. So R&D, the amount of R&D is not reflective of as compared to sales, given what the sales numbers are, given the sales growth numbers. Large negative cash outflow from operations. The company is funding operations via financing activities. Is there a going concern issue? So these are just some of the things that, doing a trend analysis and doing ratio analysis, that the auditors would look at and point to as areas of potential misstatement that they'd want to look at in more detail. Again, some of the results from doing ratio analysis. Dramatic sales increase with there being a higher increase of cost of goods sold, which resulted in a 7% decrease in gross profit as a percentage of sales. A large increase in accounts receivable, as I pointed out before, without a similar increase in allowance. The debt-to-equity ratio changed significantly in the past year, is decreasing 11%. R&D expense seems relatively low, as I pointed out before. Flash's operating profit is significantly higher than the industry, and when you consider they're so much smaller, why is it that much more, much greater than industry? In terms of comparing Flash's results to the industry results, Flash's inventory, as I stated before, is 1.8, the inventory turnover ratio, while the industry average is 8.1. So obviously this raises concern about the existence and valuation of inventory. So you're concerned about obsolescence. Their operating profit has been outpacing the industry. They're reporting over 20%, while the industry is about 14%. That doesn't seem to make sense. It's a small player in an industry. The competitors are well established and have greater access to investment capital. And we already talked about the fact that they're in a rapidly changing competitive industry. So some of one of the things that, if you remember on the slides, in understanding the client's business is understanding what their objectives and their business strategy is. And the case just asks you to list a couple of business strategies and link that to the risks as a resulting from those business strategies. So here they want, one of their strategies is to continue to expand internationally. And we talked about these risks. There's foreign currency risk. There's a lack of understanding of the culture, credit risk in new countries. The other business strategy they have is to be a market leader. So how are you going to be a market leader? You need greater access to customers. You need to build your customer base. And right now they have an insufficient customer base. We saw that. The fact that they have, 2 customers that comprise 25% of their sales. And then R&D expenses. Their R&D expenses seem to be somewhat low given the growth that they have and that they're expecting. There's some positive things about Flash technology. They have a strong cash position. The PC card market is a leading edge industry with great potential. They entered into several strategic alliances with reputable firms. They've reported strong growth, which still there's potential for misstatement there. Net income before income and taxes has doubled as a percentage of sales. Excellent market performance. The fact that they have certification for quality management is good. And potential from the audit firm's perspective, what's positive is that this is an expanding company. They're looking to grow. They're moving into international markets. So that creates for the audit firm some opportunities for additional professional services that they can perform for the firm for Flash Technologies. So let's talk about some red flags. What are some of the red flags you noticed? Do you think there was any fraudulent activities going on with this company? What? I see some heads going up and down. You just kind of feel it in your gut, but you can't point to it. It's like, or you say, there's no way she gave us a case and it's not fraud. What are some of these red flags? Let's start with that. Yes. Right. So that's a red flag. Just looking at the change. Does it make sense, right? Given, we talked about some of the things with R&D. The investment in R&D was pretty low, but here they have this huge increase in sales. The fact that they are selling a product at $300 that it only costs them $20 to produce. Right. What are some other red flags? Yeah. So there could be, so in that case, that might be an error, right? There might be more errors, or could be unintentional errors, perhaps. Yes. Right. Why are they increasing debt if they really are generating more sales? Yes, you want to say.
Turnover. That industry average so much higher.
Right. 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 What about any red flags related to management? What's your biggest concern with management? Manny, right? Right. He seems tricky. Right. So you have some concerns about Manny.
In the case that he gets what he wants, that type of person.
Right.
Shows that he might do anything to get what he wants.
Exactly. When you hear employees, and you don't, you kind of learn this a lot more when you are doing fraud audits, but these are kinds of red flags for auditors. When you hear employees describe their boss as, oh, whatever he wants, he gets. You have to do what he wants. You know, that says that there's pressure, that this is an individual who puts a lot of pressure on their employees. And not pressure in the sense that, I want you to work hard, blah, 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 but do what I say. Okay? I'm the boss. I'm in charge. You want to keep your job, do what I say. When you hear those kinds of statements coming from employees, that should automatically raise a red flag. Right? Not that the person did anything, but it should raise a red flag. Right. What else? So, as Natasha pointed out, that she uses something about Manny just doesn't feel right. Right. And so what that says, again, that is sort of like you've disclosed this information to the public. So you're going to do whatever you can, right, to make sure that this comes to fruition, or if you don't sign the contract with AT&T, to have your results look, perhaps managers like, well, our results are so good it doesn't matter. So maybe it puts more pressure on them to try to, make their financial statements look a lot better than it really is. So it creates this incentive to report or to manage earnings. Yeah.
On the Manny, the CFO, she was going to have all these negative results for a bit around Manny. She just said, oh, nothing's wrong, maybe they're working together.
Right. Right. She didn't seem to be bothered by it, right? She went, says, oh, it's just jealousy, which is, wouldn't be the response you want to get from your CFO. You would want to show what you would expect them to say is that, yeah, we heard those things, we looked into them, we investigated them, this is what we did, we concluded that, they were not based in fact. You want more than, oh, they're just jealous of Manny, right? So that's a signal about how much, how the CFO, what kind of relationship, you pointed out, does she have with Manny? Does he wield, power over her? Can he cajole her into doing whatever he wants her to do, or to let him get away with stuff? Maybe she's caught up in the Manny star, gazing kind of thing.
Yeah. Another thing that raises a red flag is allowing somebody who's a direct customer to be on the board of directors.
Right. Right. That you have this person's on your board of directors, and this is your customer. It's not it's a conflict, right? Okay. Management integrity, right? Manny, the fact that all these people are saying these things about him, the CFO's lack of concern about it, and their response to it, the fact that all these the 2008 sales were made to one customer who had a close personal relationship because they were on the, and it's a close personal friend of Manny's. There's a significant markup on the product. They made it for $20, but they're selling it for $300. Audit memo referring to empty cards. And if you remember, when the auditor was doing the plant tour, they noticed these empty these cases, and there was nothing in them. There should have been cards in them because of flashcards that they sold. And then the shipping of fruit baskets. So you shut your plant down. Here you are trying, and you have your people. You're trying to ship product, and you have your people shipping. All hands on deck for shipping fruit baskets. Most businesses wouldn't do that. You'd have that either done by a third party. You would not have that done through your production line, right? You would not allocate plant resources to shipping fruit baskets. So that would be an example. Okay, I just want to quickly show you one thing, and then we'll take a 10, 15-minute break. But one of the here it is. Okay, so it's going to be a little hard to see this, but one of the questions asks you to take the risk and then kind of walk that through the process of the auditor's concerns related, why that would be a risk for the, from the viewpoint of the auditor, what the related accounts and assertions would be, and then how that would affect the audit plan. So let's start with, let's just look at inventory turnover is much lower than industry. So we all brought, that was mentioned several times. So obviously the auditor's concern would be an overstatement of inventory due to obsolescence. And their question is inventory properly valued at the lower cost of market? So they would have concerns related to the assertions of valuation and existence. Is it properly valued, and is inventory really there? Okay, does it exist? The potential effect on the audit plan then would be examine ratios and trends to understand the inventory cost, the obsolescence concern, increase testing during the year-end physical inventory observation to establish existence, as well as testing related to inventory pricing and costing, because remember, they have inventory, they're saying that it only costs them $20 to make this flash technology. Be alert to signs of slow-moving or obsolete inventory. Inquire of operations and marketing personnel regarding outdated product. And this is, in a sense, trying to get some independent verification, right, from other than financial people like the CFO or CEO, right? So it's because marketing people are going to know whether or not they're the ones out there selling. And so they can talk to what kind of demand is out there for the product. So you want to also talk to marketing personnel. Develop analytics and analyses that examines recent sales data to establish whether inventory is properly valued. Here, again, you're trying to get at the obsolescence. You're looking at something independent of the client. The client is going to provide you with a schedule of the obsolescence reserve and those items that are included in obsolescence, and you have to, as an auditor, you have to test how accurate that obsolescence reserve is. So you look at sales on different products to determine whether or not the obsolescence reserve includes all of the appropriate inventory items in it, and it's correct. Test the client's analysis on market versus book pricing, examine their policies for valuing inventory. And then for slow-moving items that are not considered impaired, consider bringing in an expert to test the inventory valuation. Okay. Just let's look at one more, accounts payable. Even though sales and accounts receivable have more than tripled, accounts payable have decreased. Right? Also, the quick ratio is nearly 3 times the industry average. So here, what the auditor is concerned with is an understatement of accounts payable to improve quick and other balance sheet ratios. So the management is managing their accounts payable number, so they're not recording all the payables. And so if you're concerned about not all payables are recorded, then you're concerned about completeness. And some of the audit testing that they'd have to do or follow-up is inquire of the AP clerk and management regarding credit arrangements with suppliers to see if they've changed any of their policies, examine any documentation supporting policies, include a more extensive search for unrecorded liabilities. So you're going to increase the amount of your sample size with respect to the test of unrecorded liabilities. So you're going to examine payments to vendors subsequent to year end. To assure that the corresponding liabilities were correctly recorded at year end. So that's one of the ways, obviously, if management is trying to underreport accounts payable, they're obviously not going to record them. And what we're concerned with understatement is completeness, right? So that means that they did incur this expense, but they're trying to keep it off the books as of year end. So if you do, they're going to have to pay it. Otherwise, you're going to see vendors are going to constantly send them bills, call them, so forth. And you can also confirm it. You can also, confirming accounts payable wouldn't work because you wouldn't know if it's not on the books, then you wouldn't be able to confirm. So you're going to have to look at subsequent cash payments. So you would look out maybe more than 10 days. You maybe look at subsequent cash payments for January and February and tie those back to documentation to see if they should have been recorded in the reporting period. Okay. So that's just an example of, when you identify risk by doing trend analysis, understanding business risk, understanding the industry, tie that back to the financial accounting reporting risk, determine what the audit risk is, what assertion it relates to, and then what audit testing you would have to do to satisfy this assertion. Okay. Any questions on Flash before we move on for a quick break? Okay, so when we come back, we'll start on the Pinnacle case. So let's take a 10-minute break. is to perform preliminary analytical procedures, right? So what you're doing with preliminary analytical procedures, and the reason we term them preliminary, because at this point, you're only using that information to be able to identify accounts where there are potential misstatements. You are not going to know that without collecting audit evidence. So here you're collecting preliminary audit evidence. So it's attention directing, the purpose of the analytical procedures. So again, there are computations of ratios and other comparisons of recorded amounts to the auditor expectations. And the auditor expectations are formed based on what they know about the client, what they know about the industry, what they understand about the risk related to that client. That's how they're forming their expectations. So the outcome of these analytical procedures are only as good as how well the auditor forms his or her expectations. So again, that's the importance of understanding the client's industry, the client's business, and identifying the risk. We also use analytical procedures throughout the audit. So the standards basically say you have to perform analytical procedures during the planning phase, and you have to perform analytical procedures during the completion phase. It is up to the auditor's judgment if they use analytical procedures during the testing phase. So the standards only require it to be performed during 2 phases of the audit. So what's the purpose of analytical procedures and the timing? Obviously, during the planning phase, that's the beginning of the audit, your information gathering. The analytical procedures, as I said before, are attention to direct the auditor to those accounts that might contain potential misstatements, material misstatements. So the purpose at the planning stage is to understand the client's industry and business. That's the primary purpose of doing analytical procedures. So think about the analytical procedures you performed for Pinnacle. You did trend analysis. You looked at common ratios, right? Assess going concern. That is a secondary purpose. That's performed during the planning phase, and also secondary purpose at the completion phase. The assessment of going concern, most auditors will tell you that is one of the most difficult things to do, the judgment involved in that. Because you're basically being asked to make a forward-looking judgment, right? And so think about most things that you're dealing with as an auditor is not forward-looking, is looking backwards, right? Because you're gathering evidence for transactions that the company has engaged in already. There's some things that are forward-looking because you have to be able to assess, inventory obsolescence. You have to be able to assess the allowance for doubtful accounts, right? So there are some elements that are forward-thinking, but for the most part, you're not making a lot of forward-looking judgments. So going concern is very difficult. And also just what it signals to the market. So you could imagine that management is not really they're going to really fight against that, getting a going concern opinion. In fact, I don't remember what the percentages are. I haven't looked at this literature in a while in terms of going concern opinions, but there are not a lot of going concern opinions issued in comparison to the number of audit opinions that auditors issue on an annual basis. Going concern opinions are a very small percentage of that. So it's not something that auditors are doing on a regular basis. Indicate possible misstatements, so that's attention directing, as I said. That's the primary purpose during the planning phase. It's the secondary purpose during the testing phase, and it's also the primary purpose during the completion phase. So I think it's really intuitive as to why it would be a primary purpose during the planning phase, because you're gathering information at that point. Why do you think it might be a primary purpose during the completion phase? What are you trying to do what do you think you're trying to do during the completion phase of the audit? You've gathered your evidence, now what? So you do, but what, right, but what would be the purpose of doing it? So why would that be a primary purpose during the completion phase? Making sure, right? Because what you now have that you didn't have at the planning phase is more information, right? You've collected information and you're going to assess that. Now you could refine your expectations. Here, your expectations were based on your understanding of the client's business, their industry, what the risks were. So to direct you to potential misstatements. You then started the audit evidence collecting process, right? So now you have even more information. You refine, at this point, you can refine your expectations based on that information. Okay, so that's why. Then finally, reduce detailed tests. That's the secondary purpose during the planning phase, and it's the primary purpose during the testing phase, which is also optional. So you will see, you will not see an audit during the testing phase anymore, or I don't think you ever would, that consists of just analytical procedures. I don't care how strong the company's internal controls are, you're not going to only perform analytical procedures as a way of testing. Now, you can reduce, as it indicates here, your detailed tests, meaning the amount of documentation you look at by using analytical procedures if for the reason that the company that you're auditing has really, really strong internal controls, or the account that you're looking at is not a significant account. You can use analytical procedures on I don't know, other expenses perhaps, or you know, miscellaneous expenses maybe. So you might use it for those types of things, or use it where you know, you can come up with a good estimate of what the account balance should be. So those are the three stages of analytical procedures that are performed and when they're performed. Just some basic types of analytical procedures. Obviously, comparison with taking the client's data and comparing that to the industry. We saw that with Flash Technologies, and we saw some big things pop out of that with respect to inventory obsolescence. They had Flash turnover was 1.8, the industry was 8.1. So that is attention directing for the auditor. Comparing it to prior period data. Natasha pointed out that sales were just growing by a great deal from one year to the next. Client determined expected results. So comparing it to you know, client information on, so if clients made projections about what their earnings were going to be for the year, or what their earnings were going to be for a quarter, comparing their results against that, the results against that. Auditor determined expected results. So also what expectations the auditors come up with, what, for example, if you're using this type of analytical procedure in detailed testing, there might be accounts where the auditor can perform calculations that would come up, for example, interest expense. You know what the debt is, you know what the average rate is perhaps on debt, you know, the term of the debt, and you know, the auditor can perform a calculation and come up with what they think the reasonable amount of interest expense should be, compare that to what's recorded. That's an analytical procedure. Expected results using non-financial data. So where we had the case with the client auditor trying to resolve two issues, the auditor had expectations about inventory obsolescence based on the fact that the company had a new strategy. And that strategy had an impact, or what the auditor believed that the strategy would impact the obsolescence reserve. So they had some expected results using the non-financial data and the impact of that non-financial data on the company's results, financial results. So those are 5 types. These, I'm sure you are all familiar with. You've covered these in your financial accounting classes, but some common financial ratios, the cash, quick, current ratio, are all short-term debt paying ability. Liquidity, activity ratios such as accounts receivable turnover, days to collect, inventory turnover, days to sell. Ratios that measure the company's ability to meet its long-term obligations, such as the debt to equity times interest earned. And then finally, profitability ratios, such as earnings per share, gross profit percentage, and profit margin. So those are the common ratios that you see associated with financial reporting. So let's talk about Pinnacle. So tell me about Pinnacle. Who can tell me a little bit about this company? What are the circumstances here? So everybody audited Pinnacle, at least started the planning phase. So unless you found this case online or something and copied the answers, you should have read the case. So. Mm-hmm. Okay. Okay, yep. What else? Any other important factors to know about Pinnacle?
Three divisions.
3 divisions?
First division is what they're primarily known for. They've been working over 3 years. That's the diesel engine. Second one is fairly new. It's the solar power engines. And the third one is machine tech, which is basically the service and repair operations. And idealistically, basically, they want to know if they should keep machine tech this division or not. Your audit is going to determine.
Right. So what did we just cover? We understand what the industry and business the client is in, and we've also established the purpose of the audit. Right? 2 important factors that the auditor needs to establish in the audit planning process and the client acceptance process, right? Okay, so the first part of the case asks you to just, using figure 8.9, to select, I think, 4 or 5 accounts and basically do a trend analysis. So I obviously just showed some of the key, what I consider to be the key accounts, because obviously you're always going to want to look at the trend. So I would expect to see that everyone selected net sales as an account that they would want to perform a trend analysis on. Why? Why do you think that is? Why would that be my expectation? Right? Right? Net is important. It is a reflection of the growth. It's how the company earns it's their revenue, right? When we talk about fraud, I think I have a slide that shows, I hope I do, but that I normally show that talks about where fraud usually, financial reporting fraud usually occurs, and revenue by far is the largest percentage. If people are going to, when they are managing or committing financial reporting fraud, some way, somehow, revenue recognition is involved. So by its nature, it makes that a riskier account. Okay. Net sales, cost of goods sold, it's a manufacturing company, so therefore you're going to want to look at cost of goods sold. Operating expenses, income from operations, then for balance sheet accounts, receivables, inventory, accounts payable, and long-term debt. So doing this trend analysis, looking at the companies that I have here, the accounts that I have here, what jumps out? What what would you direct your attention to just based on this trend analysis, these procedures? Yes, Romel. Mm-hmm. Right. And you have to do, Natasha, were you going to say something? And inventory, you said? Net income. Right. Right. So they went from going on a downward trend in 2009 and 2010 to now being positive. Yes. Could you tell me your name again? Esmeralda. Okay. Mm-hmm. Right. Right. So again, for long-term debt, you had a negative percentage change, so it was going down, and now it's jumped up to 9.3%, right? And same thing, net receivables. Look at, I think that was pointed out, 8.6 to 51. What creates receivables? Sales. Do you see anywhere near that kind of change in sales? So that's saying, okay, what does this possibly mean? Right, a high increase in inventory. Look at the change in cost of goods sold. Right. 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 So that would be an example of how you would use trend analysis, right? Looking at the change from year to year to kind of get an idea of to tell you the initial story of what might be problematic that you'd want to focus on. Part C asks you to then, B, asks you to then choose some common ratios. I think you had to choose 5 maybe, I don't remember, right? So the ratios I have up here are just the common ones, the current ratio. So what's jumping out at you from there, from looking at these ratios? Debt to equity, what about it? Mm-hmm. Right. So you see a correlation, obviously, with the financial statements because the ratios are based on financial information, right? What else? What other things are jumping out at you? Mm-hmm.
So they took them longer to sell their inventory, so that makes me directly go back to the first one, which are accounts receivables.
Mm-hmm.
It's taking you longer to sell your inventory. How are you going to those people?
Right. And it also gives you concern about what else related to inventory. I hear murmuring. Inventory obsolescence, right? If it's taking you, why is it taking you longer? Right? At the same rate, right? Right, and so, exactly. Right. All right. What about, did anyone have any other ratios that I don't have up here? I can think of a couple that could be up there. Mm-hmm. Right. Right. So you're like, okay, so you concluded, okay, yeah, it's declining, but you factored in economic events as well to try to which is valid, right? Because you have to look at the economic situation as well, and what kind of impact what's going on in the economy will have on your customer, right? There are certain things that are recession-proof, you know, but there are quite a number of things that aren't, you know. So you would look at the impact of the economy and how that factored in. Any other ratios, any other groups who had different ratios than what we've talked about so far? You did. The first one was cash, and okay. And what did that tell you? And so, if you look at the days to sell in relation to all of the to net sales, for example, or inventory, did anything jump out at you as being a concern? Right. Okay. Right. So they're not selling. And when they do sell, it's taking them a long time to collect. Right. Were you concerned about? Did anything so far make you concerned that there could be fraudulent activity, or you just didn't have enough information at this point to determine that? Right. Because you really don't know a lot about management. You don't know about internal controls, so it would be hard to ascertain that at this point. Okay, so let's talk about, I think we might have covered the majority of these. But then looking at the trend analysis and then the ratio analysis, what we see is that there's a growth in net sales in 2011 over 2010, right? So there is some growth. However, that growth is less than it was in the previous year, 2009, 2010. The cost of goods sold continues to increase at higher rates than increases in sales, resulting in a lower gross margin percentage in 2011. Although the increase in cost of goods sold in 2011 is over 2010 was not as significant as the increase in 2010 over 2009. So just comparing, you know, the rate of growth, it's not as significant. So that kind of gets to Natasha's point that they're still profitable. They're just not growing. It's not growing as much. Apparently, Pinnacle's management made changes that have reduced the overall operating expenses, given that there's a 2.5% decline in operating expenses in 2011 versus 2010. Those changes resulted in an increase in income from operations relative to the decrease that was experienced in 2010, and a slight increase in net income before taxes in 2011 over 2010. So you'd be concerned about, you'd want to look into further what's driving that change. Receivables are increasing at significant rates, which many people pointed out, 51.3% in 2011. And that's relative to increases in sales of only 1.45%. That doesn't make sense. Like, it doesn't connect. There's a disconnect there, right? Because you would expect, if your receivables are going up and there's not an allowance problem, a collectability problem, that you would expect to see sales go up at the same rate. Or maybe they've changed their credit terms. That could be. So they've extended the amount of time that a customer has to pay off their receivable. And why would they do that? So there could be a valid reason for it, but there is a disconnect. Also build up in inventory, and so you have a concern there about excess inventory amounts and leading to obsolescence. There's a reduction in the current ratio which would indicate there might be a liquidity problem. The increase in accounts payable to finance the inventory buildup, in addition to decreases in long-term debt, suggests that management is increasing its borrowings to provide cash flow. So we expect that there's a cash flow problem because we know they're not collecting on their receivables at the same rate. For whatever reason, they're not. So they're not generating cash. So, but we're seeing an inventory buildup. The only way you're going to get inventory is if you purchase from a vendor. So we're seeing that increase in accounts payable as well as an increase in long-term debt. What else? Oh, so because of these increased borrowings, both accounts payable and long-term debt, management clearly has some cash flow issues and liquidity issues in 2011 and beyond, right? Because if you look at the fact that they're not generating a lot of cash because they have this buildup of accounts receivable, how's that going to affect them? Because especially with long-term debt, you're going to have to pay interest on that long-term debt, right? And so that's more cash outflow that you don't have. All right. So let's take a look then. So here is the part D, I think, asks you to then take that information, similar to what we did with Flash Technology, and identify those accounts where there's a potential misstatement. So this is where you had to compute the common size income statement, both on an aggregate level as well as a disaggregate level for each of the units that they own. And so looking at it on an aggregate level, three things pop out: salaries, and there could be more, but I'm just selecting these. Salaries and wages. Okay, so the estimate of the potential misstatement, salary and wages expenses are lower relative to prior years. So unless, and you didn't have, I don't think they mentioned anything of that nature in the case, there's nothing to indicate that they're laying people off, right? So what's the decrease due to? So you have to determine whether or not there were layoffs or terminated employees, and to what extent. That number of hourly workers or overtime was reduced in 2011. So what's going on there? Did they have layoffs? If they did, because that or terminations, that's what would cause salary expenses to go down. And if you are having layoffs, what's that related to? Are you just trying to become much more lean? Getting rid of excess, jobs so that you run more efficiently, or are you having financial problems and so you have to lay off? Okay. I'm sorry, say that again? Right. Right. So if they're right. Exactly. So if they're trying to cut operations expenses, that would probably be one of the first areas they'd look at. But then that's going to have an impact on other things, right? Property taxes decrease of $155,000 when property increased. So if you have an increase in property, you would expect that your property taxes would go up, right? There could be a reason it went down. What would be a reason that it went down, even though your property increased? Reevaluations or assessments, right? And that could be because of the value, but maybe they just got a tax abatement or something like that. So it might not be anything bad, but it's still attention directing, right? Bad debts, we'll talk about that when we go to the analysis in Part G. So anybody, what did other groups, some of the groups have as accounts that cause them, that they label as potential misstatement that I don't have here? Oh, I'm sorry a little bit. So it went down or up? Okay. So it almost doubled. Right. Miscellaneous expense almost doubled. So anybody else have miscellaneous expense? Yeah, so that was a concern. Legal services doubled, so you question, is a company, what might that be an indication of? Some kind of legal, are they involved in a legal dispute? Right? What's the reason for legal going up? So you'd want to know that, right? Because that's going to have an impact on the financial statement. Anybody have, what else? What did other groups have?
Depreciation increased by $694,000.
Right, depreciation expense. Why was that an issue? So depending on the method that they're using, you expect depreciation expense to be somewhat flat. Right? But at this point, you don't know the method that you're using. Right? I don't think they disclose that. So it's just that you expect it not to see a lot of fluctuation in depreciation expense. Okay. What else? Anybody else have anything else? Nick. What? Tell me what the change was. Right. So I think Lovette talked about miscellaneous and security. So you could now the other thing that you don't have at this point, right? Because you're just starting this case, is this concept of materiality, which I think next part 2 deals with that. Has some questions dealing with materiality, chapter 9. So some of these things might not be material, right? So even though there's a change, the auditor's not going to be that concerned about it because it falls under the materiality threshold, and we'll talk more about that later. But again, the point of this exercise in doing the common size income statement is what auditors do to kind of remember the part about planning. Preliminary analytical procedures are attention directing. So you're raising questions, and some of those questions you, as an auditor, you might be able to answer based on what you know is happening in the client's company and in the industry and in the economy, and others are just not going to make sense given what you know about those factors. So it's attention directing. I think someone did mention depreciation expense. Federal income taxes. So federal income taxes as a percentage of net income before taxes was 45% in 2010. Okay. 45% of 2011 of the 2011 net income before taxes would suggest that this number should be, income tax expense should be $941.9 million. Okay. And if you compare that to what the company actually recorded of $883.4 million, there's a difference of $585, which is material, obviously. So this would be an example, remember, in the types of analytical procedures where the auditor calculates, information, based on their expectations, right, using calculations. So you expect that the usually your income tax rate is pretty stable. You don't see a lot of fluctuations unless the company's experiencing losses, but your rate is somewhat stable. So a way to test income tax expense would be to do exactly this, is to take the previous year's rate, apply it to the current year's income, and then look at what the clients recorded versus what you've calculated based on this analytical procedure. So you want to look at why there's this significant difference of 585. Why is it understated? Interest expense. Short-term plus long-term interest-bearing debt increased by 22%. So when we did the trend analysis, right, you saw that several people pointed out that there was an increase in debt. So it went from $32.6 million in 2010 to $39.8 million in 2011, but interest expense decreased. That doesn't make sense, right? Nobody's loaning you money and then saying you don't have to pay interest, or we'll give you a rebate. So it doesn't make sense that your debt went up but your interest expense went down. So that obviously would be an area of potential misstatement. So if interest rates did not change, you would expect an interest expense would increase by a similar amount. So you would take the $2.8 million that they have recorded, which is the 2.2 times the interest rate of 22%. So your potential misstatement is roughly $622,000 or $623,000. So they've recorded $2.8 million times the calculation here that they came up with of 2.18, and that's your potential understatement or misstatement of interest expense. So again, this would be significant. $622,000 for this company is probably a material amount, right? So those are some areas that the auditors would look at in more detail. So the other part of it is in doing common size income statements, is to look at the disaggregated information, so the information for the different subsidiaries. And so here you had 3, Wellburn, Solar, and there was one other. I can't remember the name of it. But Wellburn, I think somebody pointed out security expenses, decrease of $70,000 or 36% of sales relative to 43% in 2010 and 2009. With the Solar Electro subsidiary, they had an increase of almost $50,000 while salaries and wages decreased. So benefits went up by $50,000, but we're seeing a decrease in salaries. So what were the benefits for? What are the payroll benefits? Again, this points back to layoffs. Did they have severance pay, right? Or benefits associated with severing employees. Legal services, someone else I think brought that up. Large increase, which could be indicative of some kind of litigation the company is involved in. And then several people brought up the miscellaneous increasing by $200,000, and miscellaneous by its nature is just that. It's miscellaneous, so it's kind of like a dumping account. Everything that doesn't really fit anywhere else goes into miscellaneous. So you're gonna want to look at that account in more detail. The objective here is that what the disaggregated information does is they help to explain or provide potential explanations for the fluctuations, whereas the company-wide data is useful in identifying what the material fluctuations are. The divisional data is helpful in determining the source, like where's the majority of the fluctuation coming from, what subsidiary. So they provide additional supporting information. Okay, so the final part, I think this is part G, asks you to analyze accounts receivable, inventory, and short and current long-term debt. So those are accounts, obviously, that were identified. You saw through the trend analysis, the ratio analysis, that these were accounts that were identified for potential misstatement. And to analyze these accounts in more detail. So here you see, with respect to the accounts receivable, what you're concerned with is the understatement of the allowance, right? Because we saw that accounts receivable is building, right? That number went up over to 53% or something. I can't remember, right, 53%. But it didn't make sense in relation to the increase in sales. You didn't see a corresponding increase in sales. So what is causing the increase in accounts receivable? And does that translate into an allowance issue, a collectability issue? So looking at the accounts receivable turnover, which is sales divided by average accounts receivable, you see that the accounts receivable turnover is from 18.2 to 17.9 to 13.9. What does that tell you? What does that suggest to you when you see those numbers? Right. It's not turning over as quickly. Right. So then you have your days outstanding, days sales outstanding, so the number of days sales outstanding. And what you're seeing then, right, is that number is going up. So your accounts receivable is outstanding much longer, right? You're not collecting. And we already kind of looked at the numbers and saw that there seems to be a collectability problem here. You have to obviously investigate that more. You're going to look at accounts receivable. One of the standard audit procedures is to confirm the accounts receivable. Right? You're going to look at the credit granting policies and how they're granting credit. How often are they reviewing credit? How are they monitoring credit, right, to their customers, to see if there's any significant changes in the credit policies, right, a longer payment terms. Are there any customers where there's a potential that the customer is facing financial difficulties, and so they are not? So you're going to look at the company's aging allowance, the aging of the allowance for doubtful accounts. This also looks at trying to take that information, what you know about accounts receivable turnover and day sales outstanding, and apply that toward estimating what bad debt expense should be. So did anyone do this? Did anyone look at bad debt expense as compared to, given the information that the ratios they computed for allowance, for turnover and days outstanding? Did anyone evaluate bad debt expense? What'd you do? This is a little convoluted, so I'm interested in hearing what you guys do. Mm-hmm. So did anyone try to figure out what a reasonable number would be? That's what this calculation is doing. Did anyone think of a way to how would you approach trying to figure, what generates bad debt expense? How do we get to bad debt expense in the income statement? Right, that's what bad debt expense is. But how does it end up in the income statement? What's the journal entry I'm asking? What's the debit? Okay, good. What's the credit? Allowance for doubtful accounts. And so do we just look at allowance for doubtful accounts and say, oops, I feel like this should be bad debt expense? What's the procedure that you have to go through? That's what I'm trying to get at. Right. The client estimates it, and we look at the history, right? The client estimates, the client assigns, if it's doing an aging analysis, percentage to each bucket, age bucket, and comes up with what they think the allowance is. We audit that, right? And one way of doing that, obviously, is looking at the history, but also in estimating, just because remember we're doing preliminary analytical procedures at this point. So one way of that is looking at, okay, is there a problem? How reasonable is the allowance? Is by the bad debt expense. Is looking at, in the prior 2 years, bad debt expense as a percentage of gross sales approximated 0.7%. Right, we see that here. However, we see that it's gone down in the current year, right? It's only about 0.56% of sales. But we also see that in 2011, the day sales outstanding, right, increased about 28.9% because it went from being 20.4 days to 26.3 days. So it increased about 29%. So if you look at bad debt as a percentage of sales, you would expect that it would increase from 0.7 to 0.9%, which would suggest, right, just based on the relationship between those three accounts, because these accounts are directly related, that you would see that it should have increased by more than that. It should have increased by about 0.9%, which would give you an estimated bad debt expense of 1.3. I'm going to post these, so you don't have to write all of this down. But what I want you to take away from this is, in doing your preliminary analytical procedures, it's important to understand the relationship of the accounts, which is why I asked you, what is the journal entry? How would allowance for doubtful accounts affect bad debt expense? Well, it's directly related, right? And so given what we know about sales and what we know about accounts receivable, how do we take that information and estimate for, on a preliminary basis in our planning process what bad debt expense should be as opposed to what they've recorded? So the company here has recorded a bad debt expense of $841. Our preliminary analysis of bad debts suggests that it should be $1.3 million. That's a significant difference. So it's suggesting that bad debt expense is understated. Right. Okay. Let's look at another one. The analysis of the inventory balance. So same approach. We saw with the inventory balance, we looked at net sales, cost of goods sold, and inventory, and looked at the trend analysis between 2009 and 2011. Some important ratios would be the gross margin percentage, and we see that gross margin is declining, right, over time, from 29.5% in 2009 to 27.5% in 2011. We also see that the days inventory outstanding, inventory turnover, this number is increasing, right? So we saw that inventory, we saw this buildup at 26%, the change between 2010 and 2011. So we already knew that there was a potential of obsolete inventory or slow-moving inventory, right? And what's the cause of that slow-moving inventory? So that's attention directing in taking those ratios and accounts that impact inventory, the relationship between sales, cost of goods sold, and inventory, looking at the relationship and how those numbers are changing and what the potential impact is on inventory. Right, and so again, we could look at just the trend analysis and see that there's a buildup, but then doing further detailed analysis or preliminary analysis, we're seeing that, yeah, it is really moving slow. The trend told us is a 26% change, and something's going on with this inventory turnover. It is not turning over. So that eliminates that, the inventory didn't just go up because we've been buying a lot more inventory and meeting demand, because we have a lot more demand. There's not a lot more demand because we see the sales numbers not growing at the same rate or anywhere near the same rate. And then finally, an analysis of short-term debt and long-term debt. What we're seeing here, we see that there are just increases across the board, but then the anomaly is that interest expense hasn't increased. It's actually decreased, and actually every year it's decreasing. But we see our debt. In 2009, 2010, long-term debt decreased, but short-term debt went up, and so did accounts payable. So long-term debt possibly just decreased because you now reclassify the current portion of long-term debt to short-term debt, right? So that's why that probably decreased. So why, if we've seen this increase in short-term debt, why aren't we seeing an increase in interest expense? So again, you want to, as the other, you saw in the previous slide, the calculation that interest expense is probably understated by over $500,000. So again, that's something that the auditor is going to perform additional testing, more detailed testing on. So how many of you concluded that Pinnacle was probably likely to fail, that there was a going concern issue with Pinnacle? Why did you conclude that? What was your rationale for that? Okay, so because of the problems with the debt, the inventory buildup, not collecting receivables, the liquidity issues, this group thought that they were probably not likely to succeed. What are some of the other groups thinking? Did every group conclude they were likely to fail? Okay, so we had at least one group who looked at, they felt they're still profitable, still making money, and so they thought it was moderate business risk, clearly cautionary, but they were not ready to say that they were likely to fail. So you didn't think they were likely to fail? No. Okay. Okay.
I thought it was a high risk because of the ratios and also the vice president had such a stake in the planning division. So I was looking more towards a misappropriation of assets. So off, I mean, they're just making his division seem like it's doing well.
Right. So you went even further and thought about, okay, there were some red flags for you, right, in terms of how the company, the results of the company, and then just some relationships that, or incentives that someone could have. Okay. Right. Okay, that's a very good point. When you talk about going concern, what the going concern opinion, when you give a going concern opinion, it's because you don't think in the next, in the current term, in the next 12 months, that the company can continue, right? And so, because you can't say what's going to happen 2 to 3 years from now, right? So, if you look, so what group were you? What's your name? I'm sorry. Ricardo. What Ricardo's group thought about was like, okay, yeah, things are not that great, but they're profitable for now. So they kind of assumed the same type of thinking as Natasha's group. But if they cannot continue at this rate, are you guys in the same group? Oh, okay. So the Natasha, Ricardo, Nick group, because they're the only ones who have their name tags, they said, look, they can't continue at this rate for 2 to 3 years, so it's cautionary. But we think they can continue for the current in the next 12-month period. So again, the point I'm making is don't get panicky, because I'm not going to. If you didn't have they're likely to continue, I'm not taking off points. So don't think that. That's not the point of this case. The point of this case is to take the information that you collected, right, in terms of the analytical procedures, the trend analysis, the ratio analysis, how you have assessed the risks and the potential misstatements, and how that helps to form your judgment in the planning process. Because remember, you're only in the planning process. So if you came from the perspective that you believe that the company is likely to fail, right? You're going to conduct your audit in terms of obtaining evidence maybe somewhat differently, right? Now, you still have to obtain evidence, right? So you might be looking for different things, right? So you might be looking for indicators of why, not necessarily that the company's going to fail, but there's this thought, okay, we need evidence to kind of show us that what we're initially concluding is not the case, right? So you might do a different type of evidence search or a more in-depth evidence search. Your judgment is going to drive that. So that's going to change your assessment of inherent risk, right? Versus if some people said it's a moderate risk, because if the inherent risk would be much higher if the company is a going concern, right? As opposed to if it's you have a moderate business risk. All right. Okay. Before we head out, I just want, because this is going to be important for the next part of the case, is to talk briefly about materiality, which is Chapter 9. Okay. So part of the case expectations for Part 2 is to identify where the audit risk is, right? And they give you some scenarios. And so given the information about inherent risk, control risk, and audit risk, the inherent risk and control risk, which is the risk of material misstatement, how are these factors going to impact audit risk? Okay, so one part of that is, when I talked about this, some of the things were clearly material. And materiality is a really important concept, and we're going to go into it in more detail next week, but a really important concept, because one of the things that we see throughout is that the financial statements are free of material misstatements. It doesn't say it's free of all of misstatements. It says free of material misstatements. Okay, that's how we conduct our audit. We provide reasonable assurance. The materiality concept is probably one of the most difficult concepts, right? Because it means different things. Materiality means different things to different people. Somebody might think $87,000 is material. Somebody might think it's immaterial. Somebody might think $500,000 is material. Someone else might say, oh, that's not material at all, right? And in terms of users of the financial statements, it's probably one of those concepts that's really hard to wrap your mind around. That an auditor waived an adjustment of $500,000, or depending on the size of the company, $1 million, because they said it was immaterial, right? It wasn't material. And so we're going to go into more detail about what that means, but it's one of the basic and major concepts in auditing, okay? And it's still an ambiguous concept. It's still very hard for people to wrap their mind around. In fact, the PCAOB has a number of concept releases out where what they've done is they've issued to the public for comments certain initiatives that they're looking at or reforms that they're looking to make. So one of the things that they talked about is auditor rotation, but another thing that they talked about was changing the audit report from what it is today. And that is geared at transparency so that it reduces the information gap between the auditor and the users of the financial statements, so that people have a better understanding of what auditors are actually doing, what they're providing an opinion on, what this concept of reasonable assurance means, and this concept of materiality. And one of the things that they have in this concept release that they're seeking feedback on or comments on from the public is, what if we have an auditor's discussion and analysis, similar to a management discussion and analysis? The difference being, in the auditor's discussion and analysis, the auditor will talk about these types of things, like materiality and how they arrived at materiality, audit risk and control risk and inherent risk and reasonable insurance. So they'll give more detail. They'll talk about the issues that came up on the audit and how those issues were resolved and why they were resolved the way that they were resolved. And this is all geared at getting at this concept of transparency and closing the expectation gap. And that's just a concept release. I mean, it's not, it's nothing, they're still seeking comments on it, but these are some of the, because these are the kinds of issues that arise. So what do we mean by materiality? It's an assessment that's made by the auditor about the tolerable misstatement of a client's financial statement. So in other words, okay, what can an average, reasonable user expect? What is going to change their decision process? When that number, what's the number that changes their decision process, that makes a difference in their decision process? So it is something that is constantly, it's not this static number, and it's not just that it's a quantitative number, and we'll go through some exercises next week. So we do have quantitative benchmarks for materiality. So you'll see 5% of net income or some percentage of total assets, right? But that's just a benchmark. That's a threshold. It can become material qualitatively as well. So even though something might be immaterial from a quantitative standpoint, the standards say, no, you can't just look at numbers. You have to look at qualitative factors as well, because that could change someone's economic decision. So I know I'm going back a little further, but think about when we did had the video on independence, and one of the questions that I asked after that video was I gave a scenario where the banker was contemplating loaning a company money. They found out that the audit partner's wife had a close business relationship with the client. And we talked about how that, for the banker, probably changed their perception of independence, right? That was material to them. We don't know that there was any problem, but it changed their economic decision. It could have possibly changed their economic decision of whether to loan money to that company or not, whether to change the terms of the loan so that they made the loan terms more stringent, right, to protect themselves. So again, that's what we mean by qualitative factors that affect the economic decision process of a reasonable user, right? And so when you consider all the people that use financial statements, what's a reasonable user? And what's reasonable to me might not be reasonable to you. So that's just the difficulty of kind of wrapping your mind around this concept of materiality. But I'm going to break here, and we're going to, it's very important. Make sure that you're prepared next week, that you've read Chapter 9, because you need the background understanding of it before we get into it next week. Also, I'm going to post which groups are going to lead the discussion of the Pinnacle case next week. 2 groups. Okay. Have a good weekend.
I was looking at the case that you were presenting. We haven't done that. We aren't close enough to yours.
What do you mean you're not?
I mean,
it's okay for you to have.
We took the chart and then we did the next 12% of that.
Right, that's a common size.
And then we kind of